Welcome back. Let's turn our attention now to the primary market. Avalon Technologies IPO opens today. The overall issue size is 865 crore rupees. And to understand more about the company, what it does, how the valuations stack up versus peers, and what its growth rates look like, Surbhi is joining in with the details. Surbhi.
Thanks for that. That's right. Avalon Technologies issue is all set to open today. The issue size is 865 crores, of which 320 crores is the fresh issue and 545 crores is the offer for sale. Now, the price band is in the range of 415 to 436 rupees per share, which gets an implied market cap of 2847 crores. The company is going to use the proceeds to reduce its debt by 145 crores and fund working capital requirements to the tune of 90 crores. Post the offer for sale, the promoter stake in the company will reduce to 51% from 71% currently. Now, a little bit about the company. It is an integrated electronic manufacturing company which focuses on high-value precision products. The company has 12 manufacturing facilities with 2 in USA and 10 in India. The company provides a full-stack product and solution suite from printed circuit board design and assembly to end-to-end box build of electronic systems. It services multiple end-user industries with close to 60% of their revenues coming from 3 main industries: clean energy, mobility and industrials. In the 8 months of FY23, which is till November 30th, 2022, it did a revenue of 585 crores with an EBITDA margin of 12% and a PAT margin of 6%. The company can be compared to other similar solutions provider companies like Dixon Tech and Amber Enterprises, and also recently listed Keynes Technology and SGS Syrma Technology. Now, these companies trade anywhere between 50 to 100 times FY22 PE, and Avalon Technologies is also valued competitively at 59 times FY22 PE.
Thank you very much for that. We're now joined by Kunhamed Bicha, the chairman and MD, and Mr. R.M. Subramanian, the CFO of the company, on the show now. Thank you very much for joining in, gentlemen. Mr. Bicha, my first question is just to understand the business model and the margins of the company versus peers. I understand that, you all are operating more in clean mobility, while companies like Dixon Technology, which are also electronic manufacturing companies of components, etc., and they cater more to ACs, but there is a big difference in margins. Their margins are much lower versus yours. Yours are, in double digits. Can you first explain, why this disparity in margins? How were you able to command higher margins, and what's the outlook on margins from here on?
Thank you. Thank you for having us. We believe we focus on industries which drive margins. So where we do a lot of mission critical stuff. We do end box builds because we do our own PCB. We're not only a PCB assembly shop, we do our own metal, we do our own cable, our own plastics. So when we integrate all these different parts from our different factories to build final products, our margins usually is on the better side in the low teens as of now, and could go better into the future. And saying that we're not into consumer electronics as much. We do products like railway signaling. We do parts inside the planes, seating and lighting. We do parts in aircraft engines. We do our existing products today are into a different type of solar, like inverters, converters, trackers. We are into making parts of hydrogen electrolyzers. So these are critical pieces which drive the margins up because it's not something which can be repeated easily.
You said there is scope for margins to improve from here on. What will drive that?
It's primarily the leverage on our capacity. We operate around 60 to 65% of our capacity today. So we have enough capacities internally for the midterm. So once you start leveraging the capacities, I think the margins should be marginally higher.
Okay. Mr. Subramanian, I believe that, obviously there's part of the issue is an offer for sale. The other, you are retiring debt and also you need the funds for your working capital requirements. So can you tell us about the money that's coming in the company? When you retire this debt, what will your debt equity ratio come down to? And what is a typical working capital cycle for you like?
The rationale for IPO, we are seeing a significant growth momentum, which is for the whole industry and Avalon in particular. We want to make sure this growth is fully funded. We've been growing at 10 to 15%, let's say. We are a profitable company and we can continue to fund ourselves. We don't need external funding. But the kind of growth momentum, what we are seeing, we want to make sure the growth is fully funded, and that's the reason we are raising money for the primary and then the company. The primary purpose of that is, of course, debt reduction. 50% of the debt will go down, and correspondingly the interest cost should go down. And over and above that, we should be generating free cash flow, which should also get the debt down. So that's the primary idea, to make sure the debt goes down and our balance sheet gets strengthened, and probably a debt equity should go to 1:1, and we have the capacity to re-leverage back as we go along. So that's the idea. We are covered for the next 3 years in terms of the funding requirement, and the key purposes are our business model is we are a capital light model, and we'll continue to remain that way. Going on to the next question in terms of working capital, we are a working capital intensive business, so to that extent we are about the steady state is about 60 to 90 days of working capital, net working capital in terms of sales. Today is about 120 days, and we believe as we go along, the component shortage should ease out, and then it should come back to normal. Okay. This is an industry-wide phenomenon, and we are exposed to that as well. But moving forward, we should return back to normal.
Yeah, I mean, I'm just asking that because a colleague was telling us that for some of your peers, for instance, for Amber, it's a 19-day cycle. A couple of the other companies ranges between 20 to about maybe 40 days. So your working capital, I believe 9 months is about 352 crores. It's been progressively increasing quite a bit over the last couple of years. Can you give us some idea of by when you will normalize it down, second quarter, third quarter, fourth quarter, how many working days, and what should be the working capital requirement once you reach this target?
So as MD said, in terms of our business is more a B2B. So technically, it's not a good comparison to do a B2C comparison. Okay, B2B is what we should look at, and in B2B there is still some amount of component shortage, which has led to the inventory increase. But we are seeing the early signs. The good news is that we are seeing the early signs of component shortage easing out, and as we said, about 12 to 18 months, we should see returning back to normal, where the net working capital cycle will be about 60 to 90 days, and that's what has been a steady state. Pre-COVID, we've been operating at that level, and we believe we should be able to go back to that moving forward as well.
Okay, got that. Gentlemen, good morning and thanks for joining us. This is Pavitra. Mr. Bicha, if I can come to you, I was looking at your revenue contribution. It is pretty, concentrated at the top, but it has come down a lot. So in FY22, from your top 2 customers, you got around 26% of revenue. In the 8 months of FY23, it's at 18%. So can you tell us what's going on there? Are there some, perhaps some large orders which are coming to an end?
So that's actually good news for us. So instead of being top heavy, what we're seeing is some large customers come in and their production has started, so that it's getting evened out. So we're going to start tracking this by top 2 customers by industry. So it's more of an evening out with new customers coming in, and some of the existing customers going to the top side.
Mr. Subramanian, you said that with the amount that you raised via the IPO right now, you'll bring down your debt by 50%. What's the outlook on bringing it down completely? Do you have any target in mind?
I think overall, suffice to say that today the debt will reach about 50 to 75% of what is today. Okay, and we will maintain, even today it's about a 300 crores net debt, out of which 230 crores is working capital or short-term debt. We should bring it down, but we'll maintain our lines and then make sure that these lines are available for us to re-leverage back as the growth momentum picks up, in which we are seeing the early signs of that, or the signs of that in terms of more customer visits, etc. That's the primary purpose of the fundraise, to make sure we use this, I won't call it once in a lifetime, a very important lifetime and an inflection point for the industry in Avalon in particular, that we use this as a pivot to grow into the next orbit. That's the purpose of what we're doing now.
Okay, got that. Just a word on, I'm going back to the point. I think you mentioned, Mr. Bicha mentioned that you're operating at 60 to 65% capacity utilization. Isn't that on the lower side? Where was it, let's say, pre-pandemic, and where do you see it going up to? And then a related question, also noticing that the contribution from your top customers has been coming down. It's not just top 2 customers, in which you can sort of say that maybe you're widening the customer base. Even if I look at top 5, top 10, the aggregate contribution is coming down. Why is that?
In terms of, I think the widening of the customer base is the key point. And number two is we are having clean energy as an important sector, which is contributing in a big way. And many of the customers are just got introduced and they are ramping up. So this is the overall impact of overall customer base going down. The other part to note is about even within the top customer base, each of them in a different sector. So Avalon as a company is fully diversified, and that's how we've been able to ride the COVID disruption in spite of COVID or component shortage. Because we are fully diversified, we've been able to manage without any disruption, continue to grow profitably during this period. This is again a byproduct of what we've been diversified, and will continue to remain so in terms of moving forward as well.
All right, we got that. Gentlemen, we're going to leave it there today, but all the best with the listing, and we do hope to speak to you very soon so that we can get some more details in terms of, your guidance going forward and what the order execution timeline is also looking like. Thank you for joining us today. That is the management of Avalon Tech telling us about, their plans with the IPO money that is going to come in, and they are looking to list very, very soon. But with that, we do need to get into a short break. By the way, a quick look at the market, because we have seen a slip. We're down around 35 points right now. The Nifty Bank has also moved into the red. So we'll do one thing. We'll take a quick break and come back, and then we're going to discuss the market technicals. Kush,